my savings. All right, so welcome everybody. By the way, so this Q&A is for whoever attends. So if you guys want me to talk about stuff, just feel free to throw it up in the chat. Go to the pop-in. It's not too late to vote. I don't have a script prepared, so I'm just going to freestyle on whatever seems interesting to you guys. Yeah, Karen was asking about my background. So, and like I said, I'm a lifelong computer programmer. I'm also like a business and startup guy. I did the Y Combinator Startup Accelerator program with Relationship Hero back in 2017. And obviously Relationship Hero is still going, still growing. So that was successful. And I had a company before this, and we actually burned surprisingly large amount of money. $170 million went to employee salaries and ultimately not to a successful business. But you know, the nice thing about the modern economy is there's a lot of investment capital available, and it's okay to burn it, and it's no hard feelings. So anyway, so that's my background. I guess Relationship Hero is the most successful company I've founded. I also have some successful angel investments, like this company Coinbase is my most successful angel investment. I invested in it when it was worth 10 million, and today it's worth like 50 billion. So I got a pretty good return on that. And then I just have a bunch of other startup investments. And I feel like I give pretty good startup advice. So I don't know if you guys have ever seen my blog. Let me send you the link. This is a website called bloatedmvp.com, and it's just a bunch of posts that I wrote. So if you're working on your own startup, you might want to read these. The theme of the blog is basically that when you do a startup, you want to make sure that you're focusing it on giving value to people and then growing the value you give, and everything else that you do is a distraction. So just like our Relationship Hero, we're always launching things that are half-baked, and then we're fixing it based on feedback. We're prioritizing what's most important to fix. That's actually like a pretty good philosophy for how to just efficiently do a startup, because there's never going to be enough resources. So it's what I call follow the value, like focus on like the immediate value instead of like, you know, a multi-year plan. All right, so yeah, so check out my blog. But in terms of what you guys want to hear about today for this session, looks like the #1 most popular thing is how to invest my savings. So for this, you know, I can give you a good summary, but I really just recommend reading I Will Teach You to Be Rich by Ramit Sethi. Like, he really covers it. I went and flipped through it in the last week because I knew that I'd be talking about this and I wanted to make sure it's still good. So I'm basically just summarizing the really solid advice that he gives. So the #1 thing that you want to do is basically have savings, right? So that's like a common issue, right? Is you got to have savings in the first place. He talks about some techniques for doing that. Like every time you get a paycheck, you know, take 10% and he calls it pay yourself first, right? So like move into a bank account and like pretend you never had it. So the first step is just making sure that you've got the savings. And if you're in debt right now, like if you have credit card debt, a lot of times the first thing you want to do is pay off the credit card debt because it's very high interest. So that could be like its own subtopic and he has a chapter about that where you really got to like find out how much debt you're in, maybe get a friend to help if you find it hard to think about or hard to look. Like getting out of credit card debt is like a really high leverage activity you can do, because the best investment you can make, like the best investing strategy you can make, isn't going to make you as much return typically as the return you can make by paying off your credit cards, because the credit cards are just high interest. And then whereas with student loans, they tend to be lower interest. So it's okay to start investing while you're still paying off your student loan. So he gives you a bunch of tips like that, right? It's hard for me to summarize everything. But let's say you start having some savings, you're able to put it in a bank account, and now it's just sitting there in cash, which means it's not earning interest, right? Maybe your bank is paying you like 0.1% a year interest, right? Which is essentially nothing. So that's an interesting question, which is also in Ramit's book. But he has a whole chapter on like, so how do you take that and put it to work? So an important fact to know about savings that you may not know is a good target rate to grow your portfolio if you're willing to take a moderate amount of risk over like multiple decades, like your retirement account essentially. A good target rate is to grow your portfolio by 8% a year in terms of nominal value, like, you know, without compensating for inflation. Like just, so for example, if you save $100 and you don't touch it and you put it in a portfolio investment, then a year from now, on average, you should expect to have about $108. Which is actually pretty amazing. And it's only possible because the economy is growing, right? Because where does that extra $8 come from? Like, why do you deserve $8 just because you didn't touch your $100, right? Why don't you just still have $100? And the answer is because there's all kinds of companies and people doing stuff in the world that are willing to take your money and give you back more money later, right? And Relationship Hero is one of those things. Like, we have investors and we promise the investors, like, listen, we're going to make profit when people get coaching, and then we're going to, so if you give us money now, we might lose it, but there's a good chance that we'll pay you back more. So, and if you take Relationship Hero and invest in like 1,000 different companies like us, a lot of them will fail, but some of them will grow. And it turns out on average, you can make like a pretty reliable 8%. And you don't have to go invest in a bunch of companies. If you go and purchase what's called an index fund, it's basically a basket of like 500, like the S&P 500, right? Like 500 different stocks. So you don't have to manage it, but you're basically getting a little piece of the economy. So we talk about the economy is growing. It means your money's growing, right? Because you're like riding on the economy. Now, a lot of people, especially younger people, they don't have the chance to do that, right? Because they haven't put away some savings. So their experience with money is it's always like you're the one paying the debt, right? Like you've got the credit card debt, and other people are basically making money off you. Like you're their investment, right? Unfortunately, so you're getting the opposite of an investment, which is that you're in debt. But one day when you can climb out of debt, then you can be on the other side of the table and you can put your money away and let other people use it and pay you back more. And the only trick is to like not give it to the wrong people, right? Because it's also very easy to lose it. But anyway, I think it's a very good fact about the world that you can make an 8% return, because once you start putting some real money in the bank, right? Like let's say you have $10,000 in the bank. Well, then you're going to make $800 on that 10,000 on average. For doing nothing, you can be sitting on the beach and your money's going to grow by $800. So that is definitely pretty sweet. So targeting that 8% return, and if you can pull up a calculator online, right? So like, let's say you put $100 and you don't touch it and it grows by 8%. And it does that for, let's say, 40 years, right? Like your entire career. So just doing some quick math here, using my browser. So 100 times 1.08 to the power of 40. All right, so that $100 is actually going to, over the course of your career, turn into $2,172. Okay, so 8% a year, when you let it go for 40 years, turns into a multiplier of 20, otherwise known as 2,000%. So it's pretty amazing stuff, the power of compounding. So basically, like if you're just putting away like $100 a month into your savings, and then you're putting it in a portfolio of investments targeting the 8% return, then by the time you retire or when you're ready to buy a house or you have all these investing goals, then you're going to have like your savings are going to grow very significantly. So you want to get that process started, right? And it all starts with getting out of debt. So this is kind of like a high level overview, right, of how to think about your money in your portfolio. And I think that number 8% is very interesting, right? Because if I told you the number was like 100%, like you could double it every year, then that would be like insane. That'd be like we'd all be rich in like a few years. And if I told you that the number was 1%, then that would be kind of a downer because it'd like barely be growing. But like 8% is like a respectable rate that we can all have. The stock market in the US, at least, like over the last like 80 years has been growing at like 8% a year. And there's years where it had like a crazy year, right? In 2020 or 2021, it had a year where it grew like 70% or something, or I forgot what it was, but like some absolutely crazy year, right? Because the pandemic made it crash but then it like came back from the crash and then it grew way more. So like an absolutely crazy year. And there's been years, I think in 2008, it had like a crazy drop of like 30% or something. But if you just ignore all the crazy movement, it averages out to about 8% a year. And it's going to keep growing like that because, companies keep innovating and finding ways to take your money and give you back more money. All right, so that's like an overview of investing. And then Ramit in his book talks about a really good hack, which is like, you don't have to pick stocks. You can go to Vanguard, at least if you're in the US, which is Vanguard is a company that just specializes in making investment really easy and simple. And, they do all the hard work and their fees are incredibly low. We're talking like 0.1% of your portfolio would be the management fee in order to get you in all the right stocks. So you don't have to think about it. And they have something called a target date fund, which it basically makes a million smart decisions on your behalf, where the idea is like, you don't just buy stocks, you buy bonds too. And you buy a big mix of stuff and you buy stocks from all over the world. So you're diversified. So that helps your portfolio. So basically they just do a bunch of like economics and math magic on your behalf. And as a result, you can just expect 8%. Like if you were managing your own money, it's easy to screw up and not get the 8%. But if you like trust Vanguard and use like the funds that they have and like don't check it too often because it fluctuates a lot, then you can rely on 8%. And that's like pretty life-changing if you just reliably get 8% and you save money every month. All right, so I hope that was a good framework. So what do you guys think? Any questions about saving? What are your thoughts on private lending? Okay, so do you want to be a little more specific? What kind of private lending? Yeah, because there's like, if your friends are hitting you up for money, that'd probably be like a high risk loan, right? Like a big risk of not getting paid back for one reason or another. There's a bunch of websites where you can do private lending, right? Like I think like Lending Club, stuff like that. Yeah, so feel free to elaborate, or I'll just freestyle. Okay, yeah, so a loan for real estate investments. I invested 100,000 at 12% for 1 year. Yeah, so the term, it sounds like the terms of the loan are something like it's supposedly like a guaranteed 12%, right? Like there's a contract where they're going to owe you 12% on top of what you gave them. But then the only problem is if their operations aren't going well, right? It's pretty easy for them to get into a situation where like maybe there's a 10% chance that they basically default or they stiff you, right? Or their entity shuts down. Like, well, we had a bad year. Okay, you say you're getting 1,000 per month. So that is definitely pretty sweet, right? Like if you can find somebody who's like, give me 100,000 and then I'll give you 1,000 a month, right? I'll give you 12% a year. That's a sweet arrangement. And if you told me that that money was, you know, extremely guaranteed, like a 99.999% chance that you're going to get paid back, I'd be like, well, that's great because that's a great interest rate. Unfortunately, because that number 12% is greater than 8%. So like anytime you hear a number that's greater than 8%, that's a really good sign that there's risk, like significant risk, because even the 8% has a lot of risk of fluctuation. Like what I told you, Vanguard, right? Kind of like the gold standard of like benefiting from economic growth. Even the gold standard makes you take a good amount of volatility risk in order to get 8%. So when you're getting 12%, unless you've gotten really lucky, right? Or like the person is basically giving you a better deal than the market would, you know, kind of like a better deal than you deserve, right? Better than fair. Something is up in terms of the risk you're taking. Now, with 12%, usually it's probably not going to be like a crazy risk, right? If they're offering you like 50% a year, then run, right? And that's honestly what you're going to see in some of the areas of crypto, right? Which is one of the many red flags you're going to see in the crypto world. But if you have some friends and they're offering you 12%, I mean, you might be getting a sweetheart deal because they're your friends, right? So if they go on a website where you can lend money to people, maybe they'll offer a lower interest rate. And maybe they're saying like, it's so convenient to just deal with my friend that I'm not even going to bother with the hassle of finding strangers to lend to. And as a result, I'm happy to pay a little more. You know, I'm essentially just like, I'm paying for convenience basically, right? I'm paying for the convenience of a friend because my money's going to a friend. It's just not a big deal. I'm getting the money now. I want to help my friend. So if it is friends, like the fact that they're your friend is sufficient to explain like a few percent, right? So that kind of like, that makes, right. So you got a sweetheart deal. And sometimes you'll find sweetheart deals. If it were a stranger offering you 12%, then I'd be like, you're probably more likely to be the sucker than the sweetheart, right? But the thing is that it's a lot of times it's hard to understand when you're investing. It's hard to understand how much risk you're taking, right? Because like, let's say you put down $100,000 and then a year passes and now you have $112,000. So you might feel like a genius, or like even you have $150,000, right? Like you did something that was, you know, your friends told you not to do it, but you did it and it worked. So you feel like a genius. But what you don't realize is that like, you have to think probabilistically, be like, well, what if I keep doing that like 100 times in a row, right? Or like, what could have happened? It's not really a good accomplishment to make money just because you got lucky, right? Because you just can't live that way. Like, sure, you did it once, but if you do it again, like eventually you're just going to get burned to the degree that you'll lose all the gains. Like on average, you're not even, you know, it's exactly like roulette, right? It's like you go to a casino, you play roulette. It's like, great, you won 2 roulette spins in a row. Like, should you feel good about that, right? No, because you're not going to bet your life savings on roulette, right? You're only going to bet a relatively small amount that you can afford to lose, and you're only going to get a couple spins out of it. So like, what does that buy you, right? Because you shouldn't go back and spin again, right? So you really have to be aware of strategies that the reward you got was attractive relative to the risk you took. And if you go to a random website and they say, oh yeah, you know, we're going to go invest in houses, we're going to give you a 12% return guaranteed in the loan contract, you're going to think that you were a genius because the 12% is probably going to come in. Like the chance that you're going to get the 12% is probably like 80 or 90%, right? So you're not going to realize anything's wrong. You're going to feel like a genius. You're going to be like, I go to this site and every year I get this 12%. But what you don't realize is that 1 out of every 10 people taking on a deal like that is dealing with not getting paid, right? So suddenly you're getting like 20 cents on the dollar and you're like, damn, I was supposed to make $1.12 on my dollar and now I'm getting 20 cents. I'm getting screwed. right? So you're just not aware that like 1 in 10 people are getting screwed, right? Because you took on some risk and you happen to win. And that's the thing about investments is like it's hard to think about because you just don't realize, it looks like things worked out for you, so you don't realize that the risk wasn't worth it. Yeah, so you're saying definitely was scary, even though they were friends. I'm not sure about doing that with strangers. Yeah, so even though they were friends, right? Honestly, unless they don't need the money, right? Because I would even hesitate to lend that to friends unless it's an amount of money that you're comfortable losing, because the problem is it's just not that hard to think about something happening to their property, right? There's like a million things that can go wrong. And then what are you going to do, right? Like, what's your plan B if they tell you like, listen, there was like some water damage that we didn't expect, right? We just don't have the cash flow. It's just really easy for them to not pay you. And the fact that you're friends, so now it's going to undermine your friendship, right? So there's like friendship risk that you're taking now too, right? So you just have to think about like the realistic possibility that the cash flow isn't guaranteed, right? People love loans because they love signing an agreement being like, oh, I'm guaranteed this money. But it's still hard to collect. Like you're not really guaranteed it. And so I actually don't do a lot of lending. I usually just do investing where the risk is just written on the tin. Like it's just very obvious that it's risky, like stocks, because I think lending is already risky. So I'm an equity investor where I like to buy a diversified portfolio of stocks. But I think, getting loans and getting bonds, that's fine too. I have those to some degree. You're just going to normally get a lower interest rate. Like if you're getting bonds that have a high interest rate, that's not really my style, because if you're getting a high interest rate, it's like now you have to like investigate where this risk is coming from. Like bonds are not supposed to generally be risky. So now you're buying a risky bond. If I'm going to take risk, I'd rather buy a risky equity. So I'd rather buy stock in a company. When you buy stock in a company, like you can go on E-Trade or Charles Schwab or Robinhood, right? And you can buy, let's say I buy $1,000 of stock in Google, right? So I think that a single share of stock might be like 2,000 or something. So whatever. So I buy 1 share of Google stock. So that entitles me to get like a tiny fraction of the dividends that the company pays every year, right? So I could be like, hey, I own like 1/1 billionth of the company Google, right? I'm like a tiny owner of Google. So what does it mean to be an owner of Google? It means that when they make some profits, and as long as they've paid back all the loans that they owe, what's left after you pay back the loans? Google doesn't have that many loans, so they have plenty of profit, and then they can distribute the profit among the equity investors. So I'm more comfortable buying equities where I don't have a contract saying like Google has to pay me 12%, but instead the contract just says, the equity contract says, Google just has to pay me like a little slice, right? Like a tiny slice of whatever profits they make. And it's uncertain how much profits they're going to make, but there's a lot of analysts being like, oh, well, Google's on pace, they're targeting earnings of 20 billion in this next quarter, right? So if you pay 1,000 for a share, you can get like $2 or $20, whatever is like your expected dividend. And then there's the extra complication that Google doesn't really pay dividends right now, so they reinvest all their profits, so their stock appreciates even without paying dividends. So it starts getting a little tricky. But like the fundamental concept of a stock is that like you get the upside of a company, but they're not obligated to pay you a specific amount. You're not a creditor, right? So they're not borrowing money from you. You're just a tiny owner that if they're doing well, you're gonna get a piece of them doing well. And also to put this in context, like I don't think that you guys should go out and like evaluate if Google's a good company to buy, evaluate if Amazon's a good company to buy. I don't think you guys are gonna be playing to your strengths if you go try to pick stocks. And even I don't try to pick stocks very often. It's just really hard to pick stocks because everybody else is trying to pick them too, and everybody's trying to outsmart everybody. So I want to communicate that the category of stocks is a really attractive category. So I think that in your savings portfolio, you should have a fund that has like hundreds of stocks in it. And that's what I'm talking about when I talk about like Vanguard or what's called an ETF. Like you can buy the whole S&P index, right? Like the whole Standard & Poor's 500 index. You can like simultaneously own like a tiny, tiny fraction of like the 500 biggest companies in the United States. And you don't have to think about it, right? You don't have to think about which of those 500 is the best because you have no idea. Like if this was 10 years ago, it turns out that the best stock in the world was Domino's Pizza. I'm not kidding. Like Domino's Pizza outperformed Google and Amazon, Facebook. Like they got really tech savvy. They sold a lot more pizzas. It was an amazing stock, right? Did I know that? No, I had no idea. But if you bought the whole S&P 500, you get a little bit of the appreciation from Domino's. And you target that 8%. Let's see. So I got a question. So you recommend playing the long game versus high immediate return? Yeah. And look, there's a simple reason why. Like unfortunately, you can't use your money to make that much more money. Like there's a few people who do that, who try to do that, but they're specialists, and even they kind of get lucky. I mean, like if you look at venture capital, right, that's like probably the most extreme example of people who are trying to like turn a small amount of money into like 10 times more money in like a relatively short amount of time. But even venture capitalists end up diversifying, so that like you hear about these venture capital successes, meaning like investing in startups. You hear about these successes like, wow, and Kleiner Perkins invested in Google when Google was like a really small company, and they turned like a $1 million investment into like 200 million, and it sounds amazing. But the thing is that it took a lot of time to do that, and also they had to make a bunch of other investments along the way because they didn't know which one was the right investment. So at the end of the day, Kleiner Perkins, like they had this amazing fund where maybe they returned like 30% a year for a few years. Like they hit it out of the park. They took a lot of risk and they returned 30%, which is like way above the average. But you can't go be Kleiner Perkins because there's that same year, there were 10 other venture capitalists investing in all kinds of other startups, and their returns were maybe not even 8% a year. And they tied up the money for a long time. So unfortunately, like if you have $1,000 and you just can't turn that 1,000 into 100,000, right? Like you can't, the only way to do it is to take a ridiculous amount of risk, right? So if you go spin the roulette wheel 10 times in a row, you'll probably lose it all. But in like that, in 1% of the time, you can show off how you turned $1,000 into 100,000. But unfortunately it's not worth it, right? The odds are bad. So I think another good takeaway from the discussion of like how to save is like, there's no way to like squeeze a ton of money out of your money. Like you basically just have to type 8% into a calculator and then like target that. Like it is what it is. And anytime you try to target more, you'll probably just end up making less than 8%. Like anytime you try to get creative, what's going to happen is you're probably going to make less than 8%. Like when 20 years go by, will you have made 8% compounding for 20 years? Whatever your creative scheme was, I'm almost certain will probably end up making less than 8%. Like you'll screw it up. So I can predict that pretty confidently. Now there is one investment that will make you more than 8%, which is investing in yourself. It's a way better investment than anything else. There's, like I think many of you here probably got started making more than 8% this year than you were last year, right? Because like the tweaks that we made in Relationship Hero got you more than 8%, I think, in many cases, right? I think some of you got like a 50% improvement, right? And that's an example of like finding opportunities for yourself that are better than the opportunities for your money. Like your money is just not going to make you a guaranteed 50% a year. The way, if you could like find a company, right? Like if Relationship Hero had a competitor, right? They'd be competing with us to pay you more. And maybe that kind of competition would lead to more than 8%, right? Like I know people in the tech industry who are getting other job offers that are like a 20% raise, right? And there you go. So investing in yourself is you got a lot more edge doing that than trying to grow your money. Like growing your money, you're just going to find people who are trying to take advantage of you by offering you a rate of more than 8% that they're going to tell you isn't that risky. Like, unfortunately, like 8% is just, it is what it is, because the world has trillions of dollars of capital and everybody wants to just park their money and grow it, right? And so there's a really big market, like everybody's fighting for the same thing, which is like, how do I make more money with my money? And like I was saying before, 8% is like a pretty good place to be. Like that number could easily be 1% if economic growth was lower. Like we live in a pretty good time where anybody can make 8% without too much work. But unfortunately, you can't really make 10 or 20% without taking, hidden risks. All right, looking at the chat room. How did you recover personally and financially from your first startup? It shut down in 2017, and then you started RH in the same year. Yeah, so here's a nice thing about corporations, really nice fact. So I had this other startup and we raised a ton of money from investors. We had a ton of employees. We were making a search engine technology for app stores. We partnered with Alibaba in China, but in the end, it was a massive failure. Like it led nowhere. And so does that mean that like I'm in debt millions of dollars? It actually doesn't at all. So this is actually an amazing thing about capitalism. So by the way, just an aside. Okay, so everybody loves to diss capitalism, right? And like and make fun of it, but you can actually be a capitalist, right? You can get the advantages that everybody's always getting mad at. You can just take them for yourself. So in my case, the advantage was I got to start a corporation, and the corporation got to take money from people, right, from investors, with a promise to pay them more money if we succeeded. But the beauty of the capitalist system is that the corporation, I think it's called the corporate veil or something. And it's the idea that if the company loses money, it's not my money. So the company is just like a separate legal entity, right? So, and I actually didn't invest any of my money. I only invested my time and my effort, right? So the investors put in their money and they were entitled to great upside if the company worked. But the company didn't work. So the agreement they had is that their money just is gone and we don't owe them any money. Like they're not, I never got sued personally for the money that my company lost. Now in Japan, if you start a company, I think, the corporations are a thing, but I think for a long time, it was very traditional that you would just, stake your reputation and your own money on it. Or even in the US, it's a pretty recent innovation. I think it was very rare. It's become increasingly common to have this kind of corporation, but like 100 or 200 years ago, it just wasn't really a thing. So as much as people like to diss capitalism, the fact that you're able to do this, even though investors kind of got screwed, and maybe the investors would do better if they got to sue me personally, on the whole, investors should actually be really happy because it creates a dynamic that encourages people to take risk. Like the reason the economy grows 8% a year is because you have a lot of people taking risks and not all the risks work out, but on average, there's a lot of big wins that are enabled by people feeling comfortable to take risks. Okay, Sean is saying, I'm interested in your advice about funding startups, getting investors if you haven't already covered it. But yeah, just to wrap up the last topic, right? So I got to basically burn a bunch of investor capital, right? Leaving them with nothing, like, 5 cents on the dollar on their original investment, right? And at the end of the day, what did I have personally? I didn't get to cash out, right? Because it's so like my labor, all I had was like the salary that I was paying myself, right? So I didn't have like an additional, I didn't get like a windfall, right, from the company because it went to zero. But the key thing is that I didn't get a negative amount, right? So it's great. You can start a company and you can screw it up and then you can walk away. And as long as you paid yourself a salary, then you're doing fine. Now, the salary I paid myself was less than what I would have made if I worked at Google. So it was a relatively modest salary, but still, like the key thing is that I was like totally fine. You can start stuff and walk away as long as you have a corporate structure, right? And as long as you're not funding it yourself, right? So you're finding other people's money where they're happy with the risk. Now, do the investors hate me? No, they don't even hate me. Like I've talked on the phone with some of my investors from the past because it's all about diversification, right? So like it didn't ruin their life that one of their investments went to zero. I've personally made all kinds of angel investments. Like I've burned $10,000 on individual investments where I would invest 10,000 and I get back like literally zero. And am I sad? No, because that was going in, the way these higher investments work, like people know that they're throwing money away in many cases, but they're hoping that in the times when they do make money, they'll make 10 or even 50 or 100 times their return. So it's kind of like playing roulette. And instead of betting on black or red, you're betting on like, that tiny slice, right? There's like a slice that has like a 1 in 32 chance or whatever, right? And it's kind of crazy. If you go put your life savings and you put it on that slice, then you're being an idiot because you're probably just going to lose your life savings. But if you take like 50 different roulette wheels, right, and you go put a tiny amount of money on that little slice on all 50 roulette wheels and then spin them all, at that point, is it a good deal or not? At that point, you have to do some math, right? You have to be like, well, how little of a slice is it exactly, right? And then you have to work the numbers. And when you finish working the numbers, you're not going to get something that's too different from 8%, right? Because there's no free lunch, right? So it's not going to be, it's going to be similar to 8%, but maybe a little higher. If you think you have a little bit of an edge, maybe you can push it to 9%. Like I personally think I have like a little bit of an edge in startup investing just because I can, I have like some connections and there's like some special things where they don't let anybody invest. Like they want what's called an accredited investor. So I'm trying to like play my little edge. I'm trying to pump my 8% up to like 12% when I can. But at the end of the day, most of my money is just sitting in what I said. So I'm practicing what I preach. So like 80% of my money. So I'm like playing around maybe with the last 20%, but 80% is just sitting there in stocks and bonds that I'm not trying to pick them. I'm just letting, I'm doing Vanguard. Okay. So I'm practicing what I preach. Okay. So let's see. So I'm interested in your advice about funding startups, getting investors. Yeah. And that's looks like that's like a pretty popular question here. People are asking, how do you get investors in the Discord, in the Poppin? So, there's no one trick to getting investors. So I'm from the Silicon Valley startup tech community where there's kind of like a playbook where investors look for, it's a certain type of business, right? They look for a scalable business, right? And they're trying to give you like an amount of money that they're okay losing as long as you're giving them a chance of like a huge return, right? So you're telling them like, look, I'm working on something that could scale to be $1 billion company. like it probably won't, but it could, right? And here's how it could if things went right. And they're like, sure, I'll give you $1 million because I think I can turn that million into 10 million or whatever. But I'm okay losing it, right? So that's like the format of a Silicon Valley company. So I suspect that's probably not what you guys are into. And frankly, that's not even really what I'm into. Like I like businesses at scale, but I personally am not, it's not really my passion to scale the company so big that you then have to like manage a really big team, right? Because then it's just like a pain. There's like if you're the CEO, if you're Tim Cook running Apple, you're just, your whole day is really busy. All right. You have a lot of obligations, you have a lot of stress. So that's not exactly my wheelhouse, right? Is to scale a company that big. But Relationship Hero, we're doing like single digit millions in revenue if you add up everybody's revenue. So I'm comfortable with that level, right? Like and that's kind of like, even like a single McDonald's franchise might do like 1 million in revenue, right? So it's like a small business level. But I'm also comfortable scaling to like tens of millions, right? And I think that's like the next step for us. By the time we're like a multi-billion-dollar company, at that point, I imagine somebody else would be the CEO, right? Like leading a more complex organization. But anyway, so there's different levels of scaling. And I suspect that if you guys were to start a business, it would probably be like a smaller business, right? Where maybe your target is to make like 1 million a year in revenue for the business, right? And maybe out of that, maybe you want to pay yourself, a couple 100,000 of it, right? That would be like your ideal, what's called a lifestyle business, where it's just like you have a lifestyle that you like, you're doing what you like, and you're getting paid well. So then the question is like, how do you get investors? So it depends on the type of business. So like if you wanted to like start your own restaurant, well then you'd have to find investors that care about that, right? So you're probably not going to find a bunch of big name investors, because the big name investors are looking for larger returns. And if you're seeking to make $1 million a year in revenue and pay yourself a fraction of that, you're looking more like friends and family, right? Like pooling together some friends and family money. You might find the government is able to lend you some money, like the small business SBA loan. The government actually supports people taking on debt to buy a small business. So like that's a thing. So I guess if you want to elaborate on the question, like maybe like describe the kind of business you're thinking of, and I'll tell you what I know about like how to finance that type of business. Yeah, if anybody has any specific type of business in mind, let me know. I just typed my book recommendation. I Will Teach You to Be Rich by Ramit Sethi. Really solid. Um, okay, for me, it's a general question, but certainly interested in specific examples. Yeah, tech startup. So I think when you guys are thinking about a business, I think you should be thinking about it like scaling up yourself, like putting on the Iron Man suit, right? So like it's you inside, like basically becoming bionic, right? So don't think about it like you have to build a robot. Think about it like you have to turn yourself, it starts as you, right? It starts as all biology, but then it slowly turns into like a humanoid robot, right? Because you're putting on a robotic exoskeleton in order to make yourself more effective. That's like how you should think about evolving your own business. So let's say you wanted to do like a restaurant or a bakery, or if anybody wants to throw out like a different type of business, or like or like you make toys for kids, like wooden toys for kids, whatever. So you could start, if you know how to do it yourself, you just start baking, or you start making the toys, or you start doing what you know how to do. And then you establish a pattern of like how it's done. And then you just ask yourself, like, how do I just like do everything twice as much? Like I'm still only one person, right? I can't split myself into two people, but how do I do twice as much business? Like what would be the easiest path to doubling the business? And a lot of times it's not complicated. Like I might be like, well, if I hire and train a person with these qualities, then I could double the business. So hiring could be one example. It might be if I can get some software written, right? If I can automate some of these pieces of software, then I could double the business, and it's like worth the investment in software. Or another answer might be like, well, I just need more capital. Like I'm constrained. If I could just buy more wood, so I could make more toys. If I could just buy more dough, like unfortunately, I only have like $1,000 to spend every month, and so I'm only growing my business slowly. And then that's called working capital, right? So now that leads into the financing question of like, oh, well, you can find investors who analyze businesses like yours, and they agree with you that you just need more capital in order to scale, and they'll give you money for that. So it really depends on what you're trying to do, right? So business kind of probably seems like this big scary category, but at the end of the day, business is just like you have an idea of something you can do that other people want to pay you for, and you can try to do it manually. But if you want to do it like twice, if you want to scale it up by a factor of 2 or a factor of 10, then you see there's bottlenecks. So then you ask the question of like, well, how do I unblock the bottlenecks if I want to scale, right? And money is just a bottleneck. So if you can do a business where money isn't a bottleneck, then that's great, because it means you don't even need investment. Like when you go get money from an investor, it feels like you're getting free money, but you're really not, right? You're getting an obligation to pay back the investor, right? So now every time you have some profit, it has to go away to the investor, right? Like some big chunk of it has to go away to the investor. So the best is if your business just starts making money, and then you can just like pay yourself some of the money, and then you can make more money and you can pay yourself more, right? That's like the ultimate business, is just a business where you just have a way to grow it. And every time you grow it, it's like not that much hard work, right? It's like a reasonable amount of work, and then you get more money out of it. And then you don't even need investors. Or if you do get an investor, it's like, okay, they give you like some amount of money that's and you take it, but you don't give them that much back for it. You're like, look, my business is great, I don't even need your money, right? You can give me some money and I'll give you back a little more, but ultimately like my business is plenty profitable. And so the real money comes out of the transactions you're doing with your customers, right? So like in Relationship Heroes case, when we pay you the coaches, we see that as an expense, right? So the profit margin is like the company's cut even after paying the coaches and after paying for marketing. But like that money is much better than investor money, right? Because when clients pay you guys and Relationship Hero takes a cut and then we put it in our bank account, we don't have to pay investors. Now, actually we do, because we took money in the past, right? But we're not going to take more money tomorrow, because the more money we take, the more money we owe. And that's not ideal. It's great to just not take money, but get it from customers. And then we can, so then like I personally can get paid more, right? So that's like my own strategy with Relationship Hero. Okay, so that's how to think about investment. Like it's not a reward to get investment, right? It's you're taking on an obligation that may be worthwhile, but it isn't the ideal to strive for, right? Because now the investors are also like they're almost like your boss, right? Like even if technically they're not. So luckily with Relationship Hero, the terms are pretty favorable, where I don't really have an investor as a boss, but like in many companies, you have what's called the board, and the investors go on your board. So now you might be the CEO of the company, but you have a board meeting and the board is allowed to fire you, or the board is allowed to basically order you around to some degree. And so now, you don't have as much control over your company. Like if you have a disagreement with the board, you have to like make the board happy. So like it works great for a lot of corporations, right? Like Google has a board, right? There's probably like at least 7 people on the board, right? I mean, it's hard not to have a board when you're in very serious business. But if you can just like do your work, right? Like get paid by your customers, like take some of the profit for your own lifestyle. Like that's how to win in business, right? Like that's like everybody wins. And investors are just like a necessary evil. Although remember, you can be on the other side of the table, right? You can be the investor, in which case it's not a necessary evil. It's a great thing, right? Because then they'll give you back 8%, right? Or like higher return with higher risk, right? So it's a necessary evil, but it's really great. Okay. All right. Is it different for starting an NGO, a non-governmental organization? And what are some ways to get funds or clients apart from social media marketing? Okay, so I think there's a lot of questions here. So an NGO or a nonprofit, right? So that's very different. That's going to have like a mission, right? So you're trying to, and it's really a whole different domain. And I have a lot less personal expertise doing that, right? But I've heard plenty of stories of people doing that. So like, Charity Water is like that guy is really charismatic. I think Scott something, he always tells how he like threw a bunch of parties for it. And he like, met a bunch of famous people to give him money for his charity, to bring people water. Like there's no one playbook for how to start a charity or a nonprofit. I personally really like the corporate structure. Even if you're doing a corporation that does a lot of good for the world, I like the corporate structure because it's really the best structure for just like funding your operations, right? It's like, even if you're trying to do good in the world, if you can just like get the people you're interacting with to pay their proportional share, right? Like the same way that you have customers, maybe they're not customers, maybe it's a charity, but the people receiving charity stuff to pay like a tiny bit so that you're not losing money. Right. So it could be like Relationship Hero, but we have like, instead of having a profit margin, like we operate at no profit margin. That could still be really nice. Like a charity often has like a negative profit margin, right? So like when they have a year of business, instead of reporting that they made some profit, they intentionally took a loss, right? Because they wanted to do a certain mission in the world. So if you can run a charity, but you can have it break even, and you could potentially even run it as a corporation, that's an option that people, I don't think, consider enough. Yeah. All right. See you later, Shauna. Yeah, so I hope that answers your question a little bit about an NGO. So, a lot of you guys are asking questions that are like very general, very broad strokes, and I'm happy to give you, overviews of stuff. A lot of times it comes down to like what you're specifically trying to do, right? So like instead of saying like, how do I start an NGO? If your question is like, how do I give poor people water? Right? That focuses the discussion very differently because a lot of times things don't neatly fall into categories, right? And it's all about like achieving the goal that you have and then like figuring out the categories later. All right. Any questions? Where could I find more info on corporate style charities? That's a great question. I don't know off the top of my head. A lot of people don't realize, like, I see corporations to some degree as charities. I mean, before Relationship Hero was profitable, right? I mean, I'm not saying that our users and our employees were a charity case. Is not at all. I mean, obviously, that's not the case at all. But like in some sense, the whole company was being subsidized, right? So if you liked working for Relationship Hero, or like if our clients like using Relationship Hero, the clients weren't paying enough, right, to make the company operate, right? So it was really investor subsidized. And if Relationship Hero had shut down before becoming profitable, then the entire existence of Relationship Hero would just be an investor subsidized experiment, right? So everybody in the system now, a big beneficiary in the system was like Google, right? Like getting paid for ads, right? So it's basically like charity for Google, right? But like my point is that corporations, a lot of corporations actually do a lot of good that they don't get credit for. And that it's not only a lot of corporations, it's actually the default case that corporations do good that they don't get credit for. Like this is a really profound concept, and it's why I'm a fan of capitalism, and I feel like capitalism gets a bad rap. So if you remember, like I made this post about consumer surplus, right? The idea that you go to the grocery store, you buy a banana, let's say you pay 50 cents, right, for a banana. Well, if you really needed to eat, you'd pay like $50 for the banana, right? Like, and in the past, people would pay like their whole income in order to be able to have a few bananas, right? Because they were poor. So we live in a society today where we don't have to spend our whole income on food. And companies aren't able to gouge us, right? Like when you go to the grocery store, you might be like, oh my God, this banana costs 75 cents instead of 50 cents, I'm being gouged. But as long as the banana doesn't cost $50, then in some sense, you're not being gouged, right? Because if the farmer had a monopoly on all the food, right, and it's like, do you want to eat? You have to pay me $50. Then you pay $50. So something about the system is working right, where you're not being gouged and you're actually getting a very attractive price on the banana. And that's true across the board, right? Like when you search Google, you don't pay Google anything, right? It's a free service. They show you ads, right? So like there's some resource that they're, you're not getting paid to see ads, right? And maybe Google makes 20 cents from the fact that they get to show you the ads, and they're not sharing the 20 cents with you, but they're giving you like this amazing search resource, right? Like Google search is like a many billions of dollars, right, to maintain Google search and make it work well, right? And you're getting to benefit from that. And imagine that the only way to search the internet was to pay a $20 a month subscription. Otherwise, you could just never search the internet. Maybe you wouldn't pay $20 a month. I'm sure everybody would pay at least a couple bucks a month, right? So we're all getting at least like I'd personally pay easily like $100 a month to search Google, right? Because I'm not going to not search Google. I need to search something. Maybe I'd use Bing, but like I need to search the internet. Okay, so essentially every month I'm getting $100 of free value from Google that I get to search the internet and they don't charge me. If one day they're like, sorry, it costs $100 and Bing also costs $100, then I'd be like, okay, take my $100. Right. So you got to realize all the times where companies are giving you all this value that they're not charging you for. And that's called consumer surplus. And they're not doing it out of the goodness of their own heart, right? They're doing it because there's competition. But the reason capitalism works so well is because it has these competition dynamics that give you the end result where everybody's just, looking out for themselves. Everybody's competing, trying to make the most money that they can for themselves. But the end result is consumer surplus, right? So the end result is we get to go to a grocery store and look around and there's all this quality produce, right? Quality granola, like all the stuff that you can buy, right, from farms everywhere. And in every case, you get to spend less than you would spend if you had to, right? So which is just an amazing outcome. And you don't tend to get an outcome like that from other systems besides capitalism. All right, so I'm looking at your questions. Let's see. So Habitat for Humanity uses sweat equity from the family they're building the home, and they also have retail stores that sell building materials from renovated home. Yeah, exactly. So Habitat Humanity, they're doing stuff, right? They're not just taking money and giving it out. They're adding efficiencies to get them toward profitability, right? Even if they're not profitable, maybe at least they're not losing that much money. All right, Sabina's saying, when was RH's last investment round and how much was the company valued? Our last investment round was kind of continuous. We've raised what's called a party round. So like a bunch of smaller checks from a bunch of different investors. So just as a simplification, you can say we raised $1 million over the course of a year, like let's around 2019, roughly. So let's say we raised $1 million in 2019, roughly. And when you ask about valuation, it was on paper 20 million. So the idea is like the people who put in $1 million, like various investors, like this investor gave us like $100,000, this investor gave us 300,000, 25,000, and they're all saying we're going to buy a piece of the company as if the company is worth 20 million. So for example, if you were to put in $20,000 as an investment, then you basically own 1/1000th of the company. So how much money would you have made? Would you have made 8%? You would have made zero so far. You wouldn't have gotten any payment from us so far, right? Because what little money we have, we're just putting it in the bank account for a rainy day so we don't run out of money. But eventually, right, maybe one day a relationship hero will have like $1 million a year in profit that we can distribute to the shareholders, right, as like a dividend. And so eventually the hope is that anybody who's invested in relationship hero is going to get paid. Now imagine that the entire company gets sold for $20 million, then those investors actually just get their money back because it's like if they put in 20,000 and the company gets sold for 20 million, they already agreed that they were buying only 1/1000th of the company. So they're only going to get 20,000 back. So they got a 0% return. At least they didn't lose their money. So really the company would have to be worth like 40 million if they want to double their money. So, and that's honestly it's a pretty ambitious objective, right? So, and they're saying like, look, I'm probably going to lose my money, but there's a chance that relationship hero can get really big, right? And some of our similar companies are big, right? Like BetterHelp is indeed a multi-billion-dollar company within a larger company called Teladoc, right? So these investors are saying like, look, there's upside potential. $20 million is a lot to say that the company is worth today, given that it's only barely profitable, but maybe it'll keep getting more and more profitable and maybe it'll keep scaling and maybe it will be a billion-dollar company or a 40 million and maybe I will get this return, right? And they package it together in a portfolio together with a bunch of other investments. The reason why I'm not saying like, hey, everybody today absolutely needs to go invest in Relationship Hero, besides the paperwork and complexity of that, is because it's as an individual investor being like, oh yeah, this company is definitely worth 20 million, and I only want to make a return if the company can prove that it's worth more than 20 million. It's a little bit of a tall order, right? It's not crazy. I'm pretty optimistic that it's going to happen, but you can see that it's definitely not like a free lunch, right? To make that bet, like there's clearly a downside scenario when you make a bet like that. Whereas if you go and purchase stock in Google or an established company, right, there's the chance that your stock is going to go to zero is so low. And then especially if you go and purchase an index fund, right? If you purchase the whole S&P, the S&P is not going to zero, okay? The worst it's ever done is like a 30% crash, right? Which a couple of years later was back up, beyond that, and pretty soon it was 100% higher than before. So yeah, I think that answers the question about RH. All right, coming up to the last 8 minutes here. Okay, so Mary's saying corporate social responsibility. Corporate social responsibility, it's basically just what it sounds like, right? It's the idea of like, hey, can we, like investors sometimes prefer to invest in companies that are showing that they're socially responsible in various ways, right? Like there's like green investments where you try to find a company that's like, you don't just care how profitable it is, you care that they're, like not burning fossil fuels, right? Or they're buying carbon credits, or they're, there's companies that are doing things you like besides being profitable, and then you privilege them for your investments. I personally am not passionate about that because I think that I think companies have their own missions, right? So like I do believe in lowering greenhouse gas emissions, but I think the best way to do that is for government to create incentives, right? So like I'm a fan of cap and trade, right? I'm a fan of carbon regulation. I'm not really a fan of altering your investment strategy to try to make your dollars tweak what companies do. I think companies should do what their mission says that they should do, right? So if you are a company, like if you're doing flights, if that's what your company is doing, I think you should just focus on doing flights, right? And if the government wants airlines, if we the people want our government to have airlines operate more cleanly, I think we can set up the incentives that every airline should operate like that. I don't think we should go to a specific airline and being like, I'm willing to pay more when I buy your stock. I'm willing to overpay for your stock because I like what you're doing. That's just not my style. Some people like to do that. I think it's just kind of like like a sloppy or a complex way to go about it. Let's see, Tracy saying, who would have ever thought we'd pay a subscription monthly to listen to music, Spotify, or audiobooks? Yeah, I mean, so that would be like a new business model, right? And there's always so companies are always innovating with like new ways to pay. I mean, even if you remember back to like the year 2000, there was a time when Google investors were saying like, Google is a terrible company because Google can't make money. Whereas now it's literally like the most profitable, best business in the world, right? Because like Google search ads are just like an incredible opportunity, right? They're like so lucrative when somebody's searching and you're showing them an ad for what they're searching for. Such a good business, right? But at the time, they didn't even figure out that business. So somebody had to invent the idea of like, what if I get a bunch of ads, right? And then I show them when the right keyword comes up, right? So that's a new business model. And as a result of that business model, if you look at all the good stuff Google gives us, right? You got Google Docs, right? Google Maps, Gmail, right? And obviously Google search, YouTube is owned by Google, right? So you have this company that's creating all this consumer surplus, and it all became possible because they just invented a really good business, right? The idea of ads. And then they wanted to like expand the business and defend it from competitors by having all these cool properties. And we as consumers just get a lot of consumer surplus, right? Like I'm currently paying, YouTube, you can use it for free. I'm paying $12 a month, right? For YouTube Premium. If you told me, look, YouTube's $100, that I'm sure that would be expensive for a lot of you guys, but like I'm personally okay paying $100 for YouTube if I could take it or leave it, because I love YouTube, right? There's like a lot of high quality videos that I like, and I'd even pay $100 a month for it if I had to. So I'm enjoying a lot of consumer surplus. Yeah, Tracy's saying I pay 100 for Google. All right. Okay, last topic. I have 5 minutes. What do you guys want as the last topic? Should I do crypto? All right, that's an interesting question. What are your day-to-day financial habits? Yeah, okay, I'll do crypto and financial habits. So my day-to-day financial habits, the answer should be like nothing. If you look at Ramit's book, right, he's going to give you a better answer than I can give. But the idea is you set it up once, right? You figure out what you're doing. So like if you're currently in credit card debt, you focus on that. You make a plan, how you're going to pay it off, figure out how long it's going to take you. If you don't have credit card debt, then you go to Vanguard, right, and you buy like a single what's called a target date fund, which really just, again, it's like you set it and forget it. Don't worry about it, and like watch your 8% a year roll in. And better yet, don't watch it, right? Because it's volatile, right? So when you're like, what the hell? I thought I was going to get 8%. I got negative 2%, but you really have to give it like a few years. So that's, so the answer should be nothing. Me personally, the bulk of my money, 80% of my money, I successfully managed to not think about and just have it be in Vanguard funds. I use Wealthfront, which is completely optional. Like it's not necessary. You can use Vanguard instead. It's the same thing. But so I managed to like not touch my investments, and like being able to not touch your investments and focusing on other stuff. That's the big win, right? Just like set it and forget it, because it's volatile. You can't do anything. There's a lot of studies show that like the more you try to trade, the more you try to outsmart the market, the more you're just wasting your time paying fees, and you end up doing worse. Now, I personally get a kick out of messing around with the market. So I take the other 10 or 20%, and I'm always trying to like invest in startups. I'm trying to like go, try to find a few individual stocks that I like. I'm betting against stocks that I think are overvalued. I'm like playing with options on Robinhood. If any of you are like just getting started with investing and you're buying options on Robinhood, that's insane. Like you shouldn't do that. I'm only doing it because for me, it's like a game, right? It's not like a serious way I'm trying to grow my money. And a lot of people don't realize the distinction, which brings me to crypto, right? So crypto is like a very unserious, unfortunately, investment. So here's the problem with crypto investing, quote unquote investing. Okay, very simple problem. The problem is that you can lose all or almost all of it. Very simple problem, right? So like I've talked to more than one person who works at Relationship Hero, which isn't known for being like a company full of like highly tech savvy people. I mean, it's known for, everybody has to be a little tech savvy, right? But we don't recruit, tech experts. And yet I've already talked to multiple people at Relationship Hero who said that like a majority of their savings is in various crypto instruments, which to me is very bad news. Now, it's not like I hate crypto. I even have a little bit of money in crypto. Why? Just because I can. Right? It's a small percent. It's actually kind of like probably bigger than it should be. It's 4%, but it's 4% that I can afford to lose. Oh, and also it's actually less because I started betting against crypto. So it's actually not correct to say it's 4%. It's like I have 4% betting on crypto, but then I also have like 2% of my money making various bets saying I think crypto is going to crash. So I'm like, you can call me like net 2%. So I'm like very slightly for crypto. I actually think it's if you had to pick one, betting that crypto is going to go up or betting it's going to crash, I'd actually say the crash is more lucrative. But don't bet either one. Like, see, crypto is not investing. Like an investment is when you're purchasing like an entitlement to the cash flow of something, right? So the stock market is great because you have all of these companies that are doing something for their customers. Their customers are paying them. They have expenses, but the expenses are less than the revenue, and so they have profits, and then they distribute the profit to the shareholders, right? So like if you own like a dam, right, on the water, and the dam's creating electricity, and as long as you maintain the dam, you get to sell the electricity, and the electricity is profit, and then you can distribute the profit to your shareholders. Buying a piece of a business like that, right, a business like Google or Amazon, right, you get to run warehouses, and you get paid for that. The world's businesses, that's where the value creation comes from. You want to own a piece of the world's value creation. If you own crypto, you might luck out. It's you would have lucked out if you'd owned it, last few years, right? You would have done great. But the problem is, my personal opinion is the price of crypto is coming from nowhere, right? The fact that all the Bitcoins today are adding up to $1 trillion. Unfortunately, I don't think that there's any solid reason why they need to add up to $1 trillion, right? I think maybe $1 trillion is the right amount. Maybe $10 billion is the right amount. Maybe tomorrow the market will discover, you know what, Bitcoin is useful as a medium of exchange. It lets you send money across countries. It's uncensorable. It lets you buy drugs, right? It's great. And it's worth 10 billion. 10 billion is a lot more than Bitcoin used to be worth. I don't think that anybody has a good reason why Bitcoin needs to be worth a total of $1 trillion today. So like, remember how I said that if you buy into Relationship Hero, you're making a bet that this company is worth more than $20 million. And if it's not worth more than $20 million, then you lose money. If you buy Bitcoin today, you're saying Bitcoin is worth more than $1 trillion. And so even in a success case where sure, Bitcoin's valuable, it's worth $10 billion. That literally means you lose 99% of your money, right? Because $1 trillion is just a really, really high price to think that Bitcoin is worth. And it gets into this whole idea of like, whenever you invest, you have to look at your entry price, right? Like what price are you getting into the investment at? Like if you like, Google's a great company, but if you tell me that I have to say that Google's worth $10 trillion, I think Google's only worth $1 or $2 trillion. So I'm not going to purchase a share of Google if I have to do it as if Google's worth $10 trillion. It's not worth it. In fact, if I invest as if it's worth 10 trillion and then Google's only worth 2 trillion, I've lost 80% of my money, even though Google's a great company, right? So you have to enter these things at the right price. And I'm telling you today, I don't think crypto's at the right price. Even if you buy Dogecoin, whatever you buy, I think you're getting a very frothy, optimistic price. And my advice is simply to steer clear unless you're comfortable waking up and seeing that the money you invested is now worth 80% less. If you're comfortable with that because you're hoping for an upside, then that's fine. And I am comfortable with a couple percent of my portfolio, right? If 2% of my portfolio is worth 80% less, I'm comfortable with that because it just means that I lost, like 1.6% of my portfolio. That's okay because I also have other investments that are diversified and that'll probably increase at the same time. Okay, so that's my thinking about crypto is like, I think that if you know how to actually invest, I think crypto is like accessible, right? It's fun. It's like something people feel comfortable with. But if you go learn what investing really is, you'll be like, oh, okay. Like crypto is not really investing, unfortunately. Okay, so that's the whole hour. So feel free to, hit me up with more questions. We can do this again if you guys want. Yeah, anybody want to throw out any last questions or comments? All right. Well, glad you enjoyed it. Yeah, it would be nice to have a second. Okay, yeah, sure. I don't mind. So I guess I'll try doing it in a different time. I mean, even if only like 2 people show up, I don't mind. What's the harm? So, all right. So we'll do it one more time. And yeah, so have a great rest of your evening. Feel free to shoot me follow-up questions and I'll talk to you later.